Hey guys, Doug the Retirement Guy. We have a review of the Curves AAPY, the Apple options traded ETF fund that they offer. Is it good for a retirement fund or is it great for income? Where do we want to establish this at? They put a nice big strong bold dividend yield out there of 14.5%, which is definitely a heck of a lot better than the 0.44 that Apple actually offers on their stock. So let's take a look at what we got and how this could fit into your portfolio. First off, Curve Yield Premium Strategy Apple ETF, short for AAPY. It's their primary strategy is taking Apple and creating income for maintaining opportunity of exposures. That's a fancy word of basically saying that they're selling options on the Apple stocks, plus they take money and invest it into treasury notes and bonds, very common in ETFs, to generate additional income from interest and returns from those investments. They work strictly with Apple stock, so this is just a play strictly on Apple, and they do a lot of things with the options trading on the premium, so it doesn't affect the taxes and works to offset in a lot of liabilities. Their distribution says they're 13.84% with a 30-day yield of 3.56. So the numbers look fairly decent compared to Apple, but let's take a look. The holdings, as you see, very common treasury bills that they put out there. They got cash on hand to buy additional shares of Apple to do the options trading on. And you see that they're in the Fidelity market. And then you see the Apple stocks that they've had and traded and back and forth. So they're definitely generating some income from that side. So why AAPY? Well, the real main goal is you're trying to achieve dividend income versus massive growth like the stock does. The Apple genuine stock will do is it'll grow, but you get nothing back from it. So AAPY sells those options trading, trying to get that 13.84% return, and they also show a 3.56 30-day yield. With that 13.84%, we say the number maybe seems high, but that's because you're dealing with options. That's going to happen. When you see those numbers, those options have to be in play. But this is a specific period of both income from your dividends and interest and capital gains to get to this 13 number. The 3.56 30-day yield says that there's a good cash potential outflow coming from this. So there's no worry that we're going to lose out on dividends and payoffs. That's a solid number from the SEC's rulings that they put through it. Now, the other big thing what is good about this fund is they offer monthly dividend payouts. As I always say, they're not guaranteed, but it's better than the quarterly payouts that Apple pays, which is only, like I said, 25 cents a quarter or 0.44% across the board. This gives you the potential to reinvest money each month, buying more additional stocks, or take the cash flow like we love here on the retirement channel, is that we like the regular cash flow so that we can pay our bills and live comfortably within our budgets. Plus, it's a very cost-effective way to get into the Apple train. I mean, an Apple share right now is $222, $230 a share, and this is going to allow you to get in for a heck of a lot less. Let's take a look at the return. 1 month, they're down 4.85%. 3 months, they're at 3.78. 6 months, 6.6. Year to date is the same as the 1 month because this is done just basically in the month of January. But when you take a look at the 1 year program, they're at 19%. So it's definitely higher than that 13% we talked about. So we put this into our calculator, and I'll tell you a couple things I learned a lot by doing this. Is we put in $10,000 investment into it. We would have bought shares on 123 for $27.85, which would give us 359 shares. If you take a look at the dividend, every dividend's about the same, from 22 cents up to 30 cents. Very, very well balanced across the board. There is a asterisk I want to put down there, is at the very bottom, where they paid $1.75, the first time ever in the history of this fund that they paid more than over basically 30 cents. So I had to figure out why were we doing what happened there? Why were we paying $1.75 in the month of December? And they came back with two things. One was just a great flow on the volatility of the stock, how well it did, and they were able to crank out additional income onto it. So I really put an asterisk that that's a phenomenon. You probably won't see that. I'd love to see that every year, but you probably won't see that unless the stock gets really volatile across the board. So when you look at the numbers at 12 months, your starting value would be up $500 or 4.99%. Your income would be $1,670 or basically 16.7%. And your total funds value would be $2,169 over your $10,000 investment or a 21% return. I give those all big thumbs up all across the board. But this is where I said this teaches you a lot of lessons. Look at January. We were able to go into January and see what kind of history happened with January. And you see that stock dropped almost $5 a share. If we would have ran this through January, we would have lost 11.85% of our value. Our income would have basically went up to $1,777 or 17.72%. And where our return would have gotten down to $593.32. Big difference from what happened at 12-month mark to what happened at 13-month mark. And we can explain what's going on. All right, let's take a look at the price adjustment over time. And we're first going to see that this fund is relatively flat and stable. But I want to show you something what we found in the chart when we did all these numbers. And the very first thing, if you look at this, back when it first started, this is January of 24. We were above about the $27 price point. If you look at the next 3 months, we dropped down below that $25 to about a $24 price range. After that, you start seeing it climb all the way back up over here in November, where it makes a major spike in December, and we saw that $1.75 change, and we saw the big price increase, and then January, we see that number drop again. So we went back even farther from as far as we could with the fund. We find out this thing always drops at the first quarter of the year for some reason, that it comes down, stables out, and then starts to head back up. This is where we started doing some math and saying the average price is $26.19. So if you had a flat line, $26.19 would be the number that you'd be. So if you're going to invest into this fund, we tell you up front, the chart shows it will hold its price value over long periods of time, but you do need to buy properly. And this is one of these funds that when we say buy on the low, sell at the high, you want to make sure that you're into this thing below that average price, and you want to stay in that $24 to $25 range to make this worthwhile from what we see. So this is the first stock I always say, always buy under the average versus hitting the average. Now, another big positive to this, though, for anyone who thinks you're dealing with risk, if you take a look at Morningstar, they rate this one as a very low conservative fund. You can't get much lower than a 1 on their 1 to 100 scale. So this fund is extremely safe, very conservative investment period. If you get the results out of it, it'd be great because you wouldn't have to worry about this. But you do have that slight little roller coaster that we showed you with the arrows to play through. So overall in our summary, the stock return over 12 months is 4.99%. So we're giving that a thumbs up. Our dividend return of 16.7%, which is 1.39% a month or $139 a month off of $10,000. We'll definitely give that a thumbs up. And your total stock return of 21.7%. That includes your dividends and interest all from the funds. We give that another big thumbs up. So overall, you know it. My answer would be yes on this account. But I will say, and I do put an asterisk to it, you want to make sure. First off, Morningstar says it's a low risk level fund, so it's safe to invest in. You're getting that 16.7% dividend rate. But remember, we're not always, December, we're always wondering what are you going to get from that. So don't always bank big time on that $1 payout there. But you have to buy below average on this one. You have to keep below that average. If you get too risky, too high into this, you're going to cut into your NAV and it's going to hurt. You're going to have to take dividends and pay off that. So buy when it's down, hold it, collect those dividends, and you'll be a great fund. Guys, this is Doug, the Retirement Guy. I hope you like the information that you're giving. If you like it, hit that like button. We're trying everything we can with this channel to give you guys the most important information for your decisions into retirement. We know it's scary and we know what you need to do. Don't miss any of our videos. Hit that subscribe button. We're constantly putting out videos like you see here, telling you what good funds you have, bad funds are out there. We work it all the way through. And best of all, if you have any comments at all, put them below. We will answer all comments to help you understand anything we're doing. Everything we do helps grow the channel. We appreciate it, and we'll see you next time.